It's mid-August. Mortgage rates are stubbornly above 7% for 2 months now. And the housing market data sure seems to indicate that home buyers are maybe growing weary. We can see signs in the data that buyers are slowing, both in the sales volume and maybe in the prices paid. The slowdown is not like last year. Instead, it's just slightly fewer buyers each week. And as a result, sales volumes are inching down, making slightly worse comparisons to last year. This is a different trend from January through June when demand was higher than we expected. It was mid-June when it looked like mortgage rates might continue to ease down, but then the opposite happened. Rates rose from 6 to 7, and that affordability impacts buyers. Those subtle shifts are useful to watch each week so that we're not surprised when some monthly number comes in the news and comes in below expectations. That volatility is why Altos Research tracks every home for sale in the country every week. We analyze all the pricing, the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the founder of Altos, and let's take a look at those signals. It's now the middle of August, 2023. Available inventory of unsold single-family homes ticked up again by less than 1% this week to 492,000. This is a seasonal inventory gain. There are 10% fewer homes on the market now than last year at this time. But it looks to me like one of those signals of slightly fewer buyers. In the first half of the year, inventory declined because demand was greater than the season would indicate. Now that extra little boost of demand seems to be gone from the housing market. I've been saying it looks like the available inventory of homes for sale will peak in 2 weeks, I think, at the end of August and start declining for the fall. In this chart, you can see the dark red line for the year is right on the normal curve for inventory. You can see how the tan line of 2021 peaked right about the same point on the curve that we're seeing this year, sort of normal seasonality balance that says we're almost back to peak inventory for the year. Assuming inventory peaks in 2 weeks, also assumes that mortgage rates don't spike from here. And while the inflation data has been steadily improving each month, the economy has stayed stronger for longer than nearly anybody anticipated. And as a result, mortgage rates have not gone down. If the economy reports surprising growth again this month and quarter, you could imagine a scenario where mortgage rates go up from here. When thinking about where housing inventory goes from here, remember this rule of thumb. Call it the Altos rule. Higher mortgage rates equals higher inventory. Lower rates lead to lower inventory. Higher mortgage rates create higher holding costs for real estate, and therefore fewer people hold real estate. We see more sales and more inventory. Lower mortgage rates spur demand and hoarding of homes, so we get less inventory. There are about 10% fewer homes on the market now than last year at this time. Last year, mortgage rates climbed rapidly and inventory climbed rapidly. That's the Altos rule. When mortgage rates eased down at the beginning of the year, so did available inventory of unsold homes. But now rates are not falling. They're staying stubbornly around 7% or higher, and therefore inventory has not yet started to decline for the fall. So look for that seasonal inventory decline to start in September with fewer sellers, unless rates jump like they did last September. So at Altos, we don't predict mortgage rates. We measure the housing market. I don't know what will happen with rates, up, down, or sideways, but we do have a lot of data for what happens to the housing market in either case. By the way, this Thursday, August 17, we will have our monthly Altos Research webinar. We'll share the latest inventory forecasts. I'll spend more time on the Altos rule for inventory, what we should expect and why. Also, home prices have held up so far this year, but are they at risk now? So we're going to cover all that on the Thursday webinar this week. There's a link in the description below to register for that webinar. So click that and join us. If we look at the transaction rate each week, the total number of new contracts for homes, you can see that in the first half of the year, the pace of sales was steadily returning closer to normal. The dark red line was approaching last year's light red line. But then in June, mortgage rates jumped to 7%, and now there are fewer home sales each week. There were 63,000 new pendings in the single family group this week. That's 11% fewer than last year at this time. For a few weeks, it looked like our sales rate might finally eclipse the slowdown from last year. But these higher rates are putting just enough damper on demand that and on supply that the pace of sales seems to have slowed again. So see the dark red line? It seems to be starting to move lower than last year again. You can see the nuance of slowdown in the price reductions data too. There are now 35.1% of the homes on the market that have taken price cuts. That's climbing by about 50 basis points per week. It's not a lot. This is a leading indicator, but it does not show like home prices crashing. But it is showing slightly more weakness than earlier in the year. In this chart, notice the dark red line improved dramatically early in the year. It dropped from cold into the normal range. Last year, the market was changing rapidly. And you can see the last year's light red line, how many price cuts were happening each week right at this point of the year. So this summer slowdown is much more subtle. Consumers are sensitive to higher mortgage rates. And each week we are seeing slightly fewer offers, so slightly more price reductions. Price cuts don't typically peak until October, so it's the slope of the dark red line that we're paying attention to now. We could finish the year with more price cuts than recent years, except for last year. So stronger than last year, but looking like it might be cooler than the first surprisingly strong few months of 2023. Home prices are holding steady in the broad sense each week. The median price for single-family homes in the U.S. is just a hair under $450,000 now. That's basically unchanged for 4 weeks in a row. And it's almost exactly the same as last year. Home prices are just a tiny sliver higher than they were last year. The median price of the newly listed cohort ticked down a fraction to $399,000 this week. That's also a tiny sliver higher than last year at this time. That's the light red line here on this chart. See how the light red line has a steady decline in the second half of each year? Last year was steeper than normal decline. So this home price measure should tick down over the next couple of months, as is normal for the late summer and early fall. If you are listing your house late in the fall, then you tend to take a slight discount to make sure it moves before the end of summer or before the holidays. And while I've been pointing out in this video slight buyer weakness, it will be really important to watch the price of the new listings to see if that price weakness accelerates like it did last year. So far, it has not. The median price of all the homes that went into contract this week is $371,000, $483. That's almost 2% lower than last week and a fraction lower than last year for the first time in months. So we have noticed in the last few weeks, mortgage rates going over 7%, that the price of the new pendings, that's what we're looking at here, the new sales going into contract each week, the price of those new pendings seems to be giving up gains over last year. This makes sense with some of the other data I've shared today. In this chart, notice the dark red line has been trading higher than the light red line. This year higher than last year for several months in a row. This week, you can see that the latest home sales prices dipped below last year. Now, I don't see this as home prices falling or cratering, like they did last year, right? They were dramatically last year, in September especially. Because they fell in September last year so dramatically, home prices will likely be up year over year by the time we end this year. Now, I've been trying to highlight that consumers are very sensitive to mortgage rates, and rates are inching up. So the higher those rates go, the more at risk our annual home price appreciation is. And that's really something to keep our eye on in the coming weeks. And that's why we track every home for sale in the country every week. There is so much signal in the active market that looking at the lagging closed sales data, price data doesn't tell you. If you need to help buyers and sellers understand the housing market, help them make decisions, go to altosresearch.com and book a free consult with our team. We will help you know how to talk about the market with your clients, with your prospects right now. There's a link in the description below. And don't forget, this Thursday is our webinar, August 17th. These are limited to 1,000 attendees, and we have already a ton of registrations. You can still reserve your spot. So click the webinar registration in the link below, in the description below. Click that, join us, register, and then be there at 10 a.m. Pacific on Thursday, August 17th for your spot. Okay, more next week.